Good evening. Today, me and my roommates are going to present about our financial analysis on Rehab Engineering. Rehab Engineering RHE, founded in 2019 by Mr. Rashidi and Mrs. Rose, RHE started as a home-based business offering repair, servicing, and maintenance solutions, specializing in test, measurement and calibration instruments as well as electronic and ICT system repairs. RHE adheres to ISO and GMP standards. Guided by a vision to be Malaysia's preferred choice, RHE is committed to delivering innovative, high-quality engineering solutions.
Now, let's move on to the problem statement. As RHE transitions from business to customer, it faces several key challenges, such as repair delays, financial stability, and resource needs. First of all, repair delays are the slow turnaround times to reduce revenue and risk customer dissatisfaction. Faster repairs are essential for profitability and client retention. Secondly, the financial stability are the revenue fluctuations that create uncertainty, affecting growth and investment opportunities. And finally, the resource needs are the expanding into the business to customer market requires hiring a marketer for branding and customer acquisition and a technician for the increased workload.
Next, I will be presenting a financial analysis of Rehab's statement of financial position for the first, second, and third years. Let's begin by looking at the overall structure of Rehab's asset, liabilities, and equity across these 3 years. First, let's talk about Rehab's assets, which represent everything the company owns. In the first year, Rehab's total assets were 14,500. By the second year, this grew to 19,000, and in the third year, it reached 22,000. This steady growth show Rehab's ability to expand its resources and invest in the future. Now, let's break this down further into current asset and non-current asset. First, current assets, which include cash, inventory, and accounts receivable, increased significantly over the years. In the third year, current asset doubled from 7,000 in year 1 to 11,000. This growth reflects improved liquidity and operational efficiency. On the other hand, non-current assets like machinery and equipment grew from 7,500 in year 1 to 11,000 in year 3. This increase shows Rehab's commitment to long-term investment in its business. Now, let's turn to Rehab's liabilities, which represent what the company owns. Total liabilities rose from 12,500 in year 1 to 19,500 in year 3. This growth indicates that Rehab has been using borrowed funds to finance its expansion. Breaking this down, current liabilities account for most of the increase. In year 3, they reached 14,500, up from 9,000 in year 1. These liabilities include accountable short-term loans and accrued, which all rose significantly. Non-current liabilities, mainly long-term loans, increased from 3,500 in year 1 to 5,000 in year 3. This indicates Rehab's reliance on long-term financing for growth. While these liabilities have supported growth, they also increase financial risk and careful management is required. Next, let's discuss equity, which represents the company's net worth after accounting for its liabilities. In the first year, equity stood at 2,000, rising slightly to 2,500 in both year 2 and 3. While this stability may seem positive, the details tell a different story. Rehab's capital contributions grew substantially from 3,128 in year 1 to 15,188 in year 3. However, increasing losses, especially in year 3 where the loss was negative 7,188, offset these contributions. Additionally, constant drawings of 5,500 each year reduce equity further. This indicates the need for better cost control and profit reinvestment strategy to strengthen the company's financial foundation.
Now, we will explain 5 key financial ratios for financial analysis. This ratio will help us to understand the company liquidity, debt reliance, and operational efficiency over 3 years. First of all, let's start with the current ratio. This ratio measures the company's ability to cover short-term liabilities with short-term assets. Over the years, you can see the 0.78 in 2021, a drop to 0.4 in 2022, and a slight improvement to 0.76 in 2023. Unfortunately, all values are below 1, indicating liquidity challenge. The sharp drop in 2022 highlights a significant struggle, while the improvement in 2023 shows some recovery, but not enough to fully address the issue.
Next, we have quick ratio, which excludes inventory from current assets. This gives a more realistic view of liquidity. The quick ratios were 0.44 in 2021, 0.40 in 2022, and 0.45 in 2023. Like the current ratio, these values are less than 1, showing heavy reliance on inventory and difficulty turning other assets into cash. The slight increase in 2023 is positive but still not sufficient.
Moving on to the asset turnover ratio, which evaluates how efficiently the company uses its asset to generate sales. The ratio were 3.7 in 2021, 4.05 in 2022, and a remarkable 6.28 in 2023. This steady improvement reflects better asset utilization and increased efficiently over time. Despite liquidity issues, the company is efficiently leveraging its asset for higher sales. Now let's discuss about debt ratio, which shows how much of the company's asset are financed by debt. The ratio was 0.86 in 2021, 0.87 in 2022, and 0.89 in 2023. These high values indicate heavy reliance on debt, with a rising trend that signals growing financial risk. The company needs to reduce its debt dependence to achieve financial stability. Finally, let's look at the equity turnover ratio, which measure how efficiently the company use equity to generate sales. The ratio were 26.8 in 2021 and 30.8 in 2022, and a dramatic jump to 55.3 in 2023. This significant increase highlights strong equity utilization and operational efficiency. It is a great sign that the company is maximizing its equity to drive revenue growth. In this session, I will explain the company's financial position that consists common size balance sheet from 2021 to 2023. First, let's discuss asset. The analysis show current asset that increased from 48.28% in 2021 to 50% in 2023, driven by growth in accounts receivable. Accounts receivable rose from 17.28% to 18.18%, indicating potential sale growth or stronger collections. Inventory slightly decreased from 20.69% to 20.45%, which could suggest better inventory turnover or reduced stock levels. Next, for non-current asset declined from 51.72% in 2021 to 50% in 2023, primarily due to depreciation. However, investment in machinery and equipment aimed at improving operations were notable. So, for office furniture and software license remain relatively stable. Next, liabilities. Current liabilities is accounted for over 60% of total liabilities throughout, rising slightly from 62.7% in 2021 to 65.91% in 2023. Short-term loans increased from 20.69% to 22.73%, showing greater reliance on short-term borrowing or to manage expenses. For non-current liabilities, the decrease slightly from 24.14% in 2021 to 22.73% in 2023. This suggests a reduction in long-term debt relative to total liabilities, potentially reflecting repayment or portion of borrowing. Finally, for equity, total equity showed decline from 13.79% in 2021 to 11.36% in 2023. Losses significantly worsened from negative 0.88% in 2021 to negative 32.67% in 2023, reflecting profitability struggles and increased withdrawals. This trend highlights the company's challenges in maintaining equity levels amid rising liabilities and losses.
Hi. To address Red Hub Engineering financial and operation challenges, we have identified several key recommendations. First is inventory management should be a priority. Reducing inventory levels by improving forecasting, production, planning, and adapting just-in-time management will help free up capital and reduce the risk of unsold or obsolete stocks. Next, Red Hub should focus on sales and marketing strategies. Expanding into new markets, launching new products, or running target marketing campaigns can boost sales and increase revenue. Another important recommendation is to improve profitability by increasing sales through market expansion or new products and controlling costs by reducing operating expenses and improving efficiency. Red Hub can generate more cash flow to repay its debt and support future growth.
In conclusion, Red Hub Engineering journey is from a home-based operation to its entry into the business-to-consumer market, showcases both resilience and ambitions. However, the financial analysis highlight key challenges such as liquidity constraints, increasing debt reliance, which is rising from 86% in 2021 to 89% in 2023, and declining equity due to losses and owner withdrawals. These issues indicate the needs for better financial management. On the positive side, Red Hub has shown strong operational efficiency, such as asset turnover improved significantly from 3.7 times in 2021 to 6.28 times in 2023, and equity turnover also saw a dramatic growth. This trend suggests the company is utilizing its resources effectively to generate revenue, laying a solid foundation for a future growth.